guys. Welcome back to another week of Mortgage Matters in Minutes. This is the 169th episode of Mortgage Matters in Minutes, and we appreciate all those who've been checking in and following and liking and subscribing. If you haven't done that yet lately, go on down the bottom here and make sure you comment about some kind of a video that you want to be educated or informed of, but also hit that subscribe button so each and every week you can gain some interesting mortgage knowledge in 5 to 7 minutes. So today we're going to talk about why are mortgage rates so sticky in 2020-25 and what the Fed is not telling you that maybe you already know or feel in your everyday living life. So the question of the day is, the Fed's obviously continued to announce that they may be lowering interest rates in the future, or they are going to, but now all of a sudden, why have mortgage rates not followed suit, and why have mortgage rates not come down? So let's talk a little bit about that, because consumers think many of the times that what the Fed does with the Fed fund rate, which is an overnight rate that banks borrow money back and forth from each other, that directly impacts mortgage rates. And we've talked about that in the past. That does not directly impact mortgage rates, but it is still something to follow, because what the Fed is trying to do ultimately is keep the United States economy moving forward at a good pace, not too fast, not too slow, just at the speed limit, if it's an easy way to think of it that way. So they make changes throughout time with that particular interest rate. So hopefully they can keep it at that speed limit. They're never going to be perfect. No matter how much data and information is occurring, they could always be late in the process of making things happen. So the Fed fund rate affects short-term money, not long-term money, and that's what mortgages are, is an investment on guaranteed money or lower rate of return over a longer period of time. And how do they do that? They look at, the secondary market creates mortgage-backed securities as an investment. So if you had, some monies, 5 million, 20 million, 100 million, 500 million, and you wanted to invest, but you wanted a very low rate of return, but a very good guarantee, or the best guarantee that you can without losing money, mortgage-backed securities might be a good investment for you. Or you could look at a 10-year treasury. So mortgage-backed securities generally follow what the 10-year treasury is doing. So as the 10-year treasury is coming down, mortgage-backed securities come down. 10-year treasury goes up, mortgage-backed securities go up, because most people don't keep their loan truly for 30 years. They might keep it for anywhere from that 4 to 10 years, because markets will go up, markets will go down, interest rates will go down, up, interest rates will come down. And what will happen is usually a consumer is going to refinance their loan within that 10 years, pay it off, or possibly move. So if you are an investor, you're looking at both of these two as an investment. Which one would I want to go into? And maybe which one is giving me a better rate of return right now? So when you're looking at investments, these two are in the same kind of section together of risk. So you look at which one's paying you obviously better that day, and those two compete against each other. So let's talk about what's keeping things down right now. Why are rates not on their way down? Why are rates staying up and not coming down? Because we're all feeling the crunch. We're talking to clients all day long about their financial decisions. People talk about how expensive things are. They feel it of not doing as much traveling or vacation or spending extra money on things. That's really usually a signal that we're in or on a path to recession. And we've talked about that as well before. But with the recent tariffs that have came out, we have a really big global uncertainty. And so while maybe the Fed decides that they want to cut interest rates, with the uncertainty of what's going to happen moving forward, they don't want to do something too soon that they can't come back on. So if they decide to start cutting rates now for whatever reason, but then all of a sudden something major changes in the future, it could affect things drastically that the Fed can't do anything to offset the situation from happening there. So that is a big reason why things are going on. But also one of the major reasons is inflation. We, with numbers, would have anticipated we would see lower inflation numbers by now. As inflation comes down, interest rates will come down. As inflation goes up, interest rate goes up. So Right now, we're looking for the Fed to give us information about what's happening with the global markets, what's happening with inflation, and what's happening with the labor markets. And as we see those particular situations change, interest rates will change with it. So, in order to incentivize individuals right now to invest in the mortgage backed securities, they have to give them a higher rate of return, i.e., why we have higher interest rates for consumers right now. And I can't say that a 7% interest rate is a high rate. It's just a higher interest rate in regards of the average home price or average loan amount that you're going to be borrowing. If we look back into time, people say, hey, I remember when rates were at 14, 16, 18%. But I will joke and say I remember that time when house prices were $30,000 to $50,000. We're just in a different time of where costs are of goods and interest rates are. So, what can you do as a buyer to, look at this situation and decide if it's still a good time for you? One thing I can share with you is we're still seeing a lack of inventory. There's only so many properties that are available for the amount of people that need them. So, housing, as we see it, is always going to be a need. Anytime there's a need for something, the value is going to continue to keep its value or increase in value. We can never guarantee that. We can never promise that. But if you look at time, just like the stock market, we've talked about this a lot, the line looks at an upward pace. Values go up, stock price values go up as well too. So you also can look at taking possibly a short-term adjustable rate and then maybe playing that little bit of a gamble thinking, hey, moving forward, I might be able to refinance into a fixed interest rate. We're still seeing that, but the ARM loans aren't nearly as available because lenders need to keep loans for nearly about 3 years in order for them to break even. So that's the servicing piece of it. As they're putting a lot of time and effort up front, they want to keep a hold of that investment. So each month when payments are coming in, they take a small portion of that, not the full 7% interest rate, as for example, but a small portion of that. You also can look at temporary and permanent buy downs, which is actually putting up money up front to take a lower interest rate, either in the short run or for the long term of the loan. We look at these scenarios for all of our clients and give them some advice and give them the pros and the cons of all these things, because there's nothing free about any of these extra incentives. You're taking a risk to take an adjustable rate. You're putting up money to take a lower interest rate as well too, but they might not always fit your time frame or your scenario as well. We also see lots of clients looking to time the interest rate market exactly, and that's very challenging, just like timing the stock market's ups and downs. What we're looking at right now is when you get under a contract, you might only have 2 or 3 weeks to lock in that interest rate. And if the fluctuation has been really up and down, it's not easy to know exactly what day to do the lock. But if you're doing your pre-approval and you're looking at the numbers, run the numbers more of a worst case scenario for you and what fits into your budget, not really what the perfect interest rate is to get you a cheaper payment. Yes, our goal is to work to find clients the cheapest interest rates because they're happy. But does that happen every day? No, we have to take the rates of where they're at in the environment that we're in, and that's just what's going on. What's going to happen in the future is your guess is as good as mine. People can predict and guess one way or the other, but we're not going to know until it actually happens. So we live for now, trying to do the best decision we can for the future and give you the best advice we possibly can. I'm Brent Rasmussen, owner of Mortgage Specialist. We're here to answer any questions anytime for you. Just a phone call away at 402-991-5153. Check us out on our website, mtg-specialist.com. And we'll look forward to seeing you here next time for our weekly Mortgage Matters and Minutes. Have a great rest of your week. Mortgage Specialists. Driven, trusted, reliable.